about 307 billion naira worth of notes were sold at Wednesday's Treasury bills auction compared to the 157 billion naira offered. Meanwhile, the auction results show a further reduction in the stop rate on the one-year Treasury bill, which came in at 6.8%. Now, also strong second quarter data showed renewed pace of economic growth for Nigeria. So what does this mean for the markets going forward? Egie Akpata, director at UCML Capital, joins me for this discussion. Egie, thank you. Great to have you on the show today. Let's get right to it. Where do we start? Markets, or let's quickly take the GDP? I'd just like to hear your perspective on the GDP numbers we just received this morning. I'm sure you probably heard my conversation with Andrew. But for you, what would be a quick shot in the arm for the economy? Analysts continue to tell us that we need to bring in those much-needed investments, FDI, both domestic and foreign, but we still aren't able to get that right. Talk to us about what we can do despite or in spite of some of the discouraging news still coming out of the country. Andrew mentioned subsidy, we have insecurity issues, etc. What are your thoughts?
Good afternoon, Esther. Thank you for having me on the show. In terms of the GDP numbers, I think the number 5% looks large in a normal year, but in reality, compared to very down Q2 last year when there was full lockdown, it's probably not as impressive as it looks. I think a more important number to look at in that report is the month-over-month. Quarter-over-quarter real GDP growth, which was negative, is around 0.79%. In comparison, if you look at some other large economies out there, maybe the US, Q2 was 6.5%. This is a $20 trillion economy. It's a large base compared to sub 500 billion Nigeria. So it does seem large, but I don't think it is something that will be particularly exciting to any market participant.
Okay, speaking about markets, let's move over now to the Treasury bills market. We had the results coming out yesterday. The rate yield on the 1 year, the 364-day paper coming in low at 6.8% from 7.35%. Now, why are we seeing these yields falling, even with inflation still above 17% and the government still borrowing heavily?
Yeah, I think it's somewhat structural reasons. Banks have a liquidity ratio of 30%, so they have to buy some instrument to park that money. They're trying to avoid long-term paper, so they're probably piling into 1 year T-bill. There are also a number of fund managers who have minimum amounts of Treasury bills they need to hold. So everybody's rushing for the 1 year, and that's depressing the rates. I think it's a bit interesting to see the amount of 6 months sold on a 2-day paper sold at 3.5. It suggests that people actually are starting to get comfortable with these very abnormally low rates. I think what's interesting with that auction result is how much new issues there were. I mean, they came to the market for about 157. They issued about 307. So they bought an extra 157 billion naira in the T-bill market. Historically, there wasn't much borrowing in the T-bill market, but clearly the government's looking at the 6.8. I'm thinking it's a lot cheaper than paying 11-12% in the bond market. They will have to refinance next year, but I guess they are trying to tackle the debt service problem by paying lower interest rates on their borrowing.
Yeah, absolutely right. And I think that takes me to the planned Eurobond sale, 6.2 billion US dollars. Now, what we've heard so far so far this year, the Eurobond market has been relatively stable, and of course the corporate bond segment of the market has been bullish. But for Nigeria, and for when a sovereign goes to the market, the economy of the issuer is a key factor, a key determinant when a country approaches the market to raise funds. For Nigeria, how do our macro indicators stack up, and to what extent would they be giving foreign investors some confidence or comfort when we do go to the market?
Well, I think in Nigeria's case is a bit different from most other African issuers in that the foreign investors just look at oil sales. So there's a tight correlation between the performance of Nigerian Eurobonds in the market and oil price movements. Past 2 days, Eurobonds have been going up, but for a week they were in free fall when oil was falling. So the foreign investors probably are not as concerned about the internal macroeconomic variables. They just want to see that you have the foreign exchange coming from oil sales that can help repay this foreign debt. Obviously, as the foreign debt is rising, you're going to start getting less and less comfortable. But I don't think Nigeria's ratios are remotely anywhere near countries like Angola and Ghana, where it's very clear that the ability to service foreign debt is very challenged. I think total debt service on Eurobonds last year was sub $1 billion. So it's not a threatening number yet. But as long as oil holds up, the investors will be fine. Whether they are ready to absorb 6 billion when only 9 billion is outstanding, it's a different question. And I think the number being quoted is up to 6 billion, which suggests it might be a lot less than $6 billion issued.
Now, with the if that goes well, so that's 6.6 billion or 6.2 with the addition of the 3.5, I think, from the IMF special drawing rights. I remember I was asking an analyst yesterday, what does that, of course, that's more money coming into the FX reserves. That's more firepower for the CBN. So what does that, in what ways does that boost the local currency here, if any? And what does that do for our FX market?
Well, on paper, gives you more reserves, more import cover. But again, it depends on what the central bank decides to do. There's a large amount of foreign portfolio investors still trapped here, probably 5 billion or so. So what do they do with them? If they were to pay them out gradually over the next 6 months, then those reserves suddenly don't look as big as they sound. And so it all depends on CBN policy. But it's definitely good for the official market. Parallel market is a different story. But for the official market, it means that this 411, 412 probably should be around for the next 6 months or so.
Okay, we have less than 2 minutes left. Let's get back to the fixed income market. So do you expect this trend to continue, especially on the one-day paper? And could we see, because if we have all these monies, especially from the Eurobond and coming into the federal government's coffers, could we see a significant drawback from the domestic borrowing side?
Yes, that's very possible in Q4. If you track the numbers, year to date, the DMO is tracking way ahead of schedule in terms of total borrowing. They've been doing a lot of borrowing through the table market, probably almost 800 billion, which is quite the opposite of what they say their strategy is. So when you add that to bond sales, it's possible that in Q4, sales be a lot less than have been going on so far, about almost 200 billion a month. And if that does crystallize, then rates will go lower, which is part of the reason why bond yields have been trending down for the past 2 months. There's the feeling in the market that if maximum amount of foreign borrowing happens in September, then local currency borrowing will significantly reduce.
All right.
The last quarter of the year.